All right, welcome to The Explainer. Today we're jumping right in to decode the professional's playbook for turning a great trading idea into a strategy that actually, makes money. Let's get to it. I want to start with a number that should really make you stop and think. 80%. If you've ever had what you felt was a brilliant trading idea, well, this number is the wall you're up against.
And there you have it. That's the harsh truth, according to Web Cornucopia Finance. There's this massive gap between what looks good on a spreadsheet and what actually works in the real world. But here's the good news. Today, we're going to break down the systematic framework the pros use to make sure they land in that winning 20%.
So why do so many promising ideas end up in what we'll call the strategy graveyard? Well, it usually comes down to a few common but absolutely critical mistakes. And the best part is you can totally avoid them if you just know what you're looking for.
First up is maybe the most seductive trap in all of backtesting. It's a real siren song for traders, and it's called overfitting.
And this is where things get so tricky, right? Because you think, hey, I'll just keep tweaking parameters until this thing is perfect for the historical data. But what you're really doing is building a flawless machine for a world that doesn't exist anymore. You're training your strategy to fight the last war, not the next one. So it becomes incredibly fragile, and it's almost guaranteed to shatter the second it faces live market conditions. The solution? You have to test it on data it has never seen before. That's the only real test.
Okay, next on the list is a much sneakier error. It's more subtle, but man, it can dramatically inflate your expectations and give you a really dangerous false sense of security. It's called survivorship bias. This right here uncovers a fundamental flaw in how most people run their tests. I mean, think about it. If you only test your strategy on the stocks that are still around today, you're only testing it on the winners. You're totally ignoring all the companies that went bust, got acquired, or were delisted. Including these ghosts from the market's past in your data gives you a much more realistic and, frankly, much more sobering view of your strategy's true potential.
And finally, let's talk about death by 1,000 cuts. These are the real-world costs, the little things that are so easy to forget about in the theory stage, but can bleed a great-looking strategy completely dry. Here's the bottom line. A strategy that looks profitable on paper means, well, it means nothing. A strategy is only legit if it's still profitable after you've paid the broker, after you've accounted for slippage and the bid-ask spread. For really active strategies, these costs can easily gobble up 2, 3, even 5% of your annual returns. That is more than enough to turn a star performer into a total loser.
Okay, so we've walked through the graveyard and seen all the ways a good idea can go wrong. Let's flip the script and talk about the antidote. Let's dig into the professional's playbook for building strategies that are tough, durable, and can actually survive in the wild.
And listen, this isn't about some secret magic formula. It's all about a rigorous, disciplined process. This 6-step framework is what separates professional results from amateur guesswork. It all starts with defining your rules with crystal clarity, no gray areas. Then you gather clean, high-quality data, run your first backtest, and then you have to dive deep into the performance. But here's the crucial part. You then stress test the strategy. You try to break it before the final validation on unseen data. You see how each step builds on the last? You're basically building a chain of evidence for your strategy's viability.
So you've done all the heavy lifting. You've run your strategy through the framework, and now you're staring at a page full of numbers. So now what? How do you actually measure success? Which numbers truly matter, and which ones are just noise?
You know, this is one of the biggest traps out there. A 90% win rate looks amazing, doesn't it? But it's a classic vanity metric. It's totally misleading because it tells you nothing about the size of your wins versus your losses. You could win 9 trades for $10 each, but if that 10th trade is a $100 loss, you're still down. Professionals obsess over the profit factor instead. Why? Because it directly compares your total profits to your total losses. A profit factor of 1.5 means your winners are, on average, 50% bigger than your losers. Now that is a healthy sign.
Think of this table as your strategy's official report card. No more guessing. These are the clear, objective benchmarks that the pros use. You've got the Sharpe ratio, which measures your return per unit of risk. You have the max drawdown. This one is huge. It tells you the biggest peak-to-trough loss you would have had to endure. It's a real test of your stomach. And of course, our friend, the profit factor. Aiming to be in the good or excellent columns is what separates a trading hobby from a trading business.
Okay, so you've done the work, your metrics are looking solid, and you're feeling pretty good. But before you go live, there is one last final reality check. Think of this as your last line of defense for protecting your capital from a cleverly disguised flawed backtest. If your backtest results look like this, do not celebrate. You should be suspicious, really suspicious. Results that look too good to be true almost always are. A Sharpe ratio over 3 years without a single losing month? That isn't a sign of a holy grail strategy. It's a giant flashing red flag pointing to one of those deadly sins we just talked about, almost certainly overfitting. When you see these numbers, it's time to hit the brakes, stop, and re-examine your entire process from scratch.
And really, that's what it all comes down to. The difference between a profitable reality and an expensive illusion isn't some stroke of genius or a lucky break. It's a commitment to discipline. It's about using a professional validation process, focusing on the metrics that actually matter, and watching out for those red flags. That way, you can answer this question with confidence before the market answers it for you.